Is it possible to predict when the Federal Reserve will cut rates? The Federal Reserve is charged with the responsibility of monetary policy, utilizing various tools, including setting interest rates. Interest rates impact every facet of our economy and can contribute to booming bull markets or housing crashes. In order to determine the appropriate level of interest rates, the Fed watches two key economic barometers: maintaining stable prices, in other words, preventing excess inflation, creating an environment that allows for maximum employment. This careful balancing act between inflation and growth can prove to be very challenging. We're going to make our call. Based on our many years of historical data, we're going to show you under exactly what conditions the Fed will embark on a new campaign of interest rate cuts. The most common tool used to calculate the odds the Fed will cut rates are the Fed funds futures. Of course, this point, we know the Fed left rates unchanged in their latest meeting in March. The blue line shown here shows the Fed funds futures predicting no change in rates, which has settled at 100%. What is this telling us about the economy? When the Fed leaves rates unchanged, number one, the inflation rate is still too high to consider a cut. The Fed maintains a 2% target, which so far we have yet to achieve. Number two, the economy is strong enough to function under the current high interest rate environment. For that reason, once the Fed funds futures cross above the 50% mark, we tend to see quite the strong correlation. As the probability the Fed will not cut rates, stocks take this as a sign of a strong economics and they rise in kind. The next scheduled Federal Reserve meeting will take place in May. The odds the Fed will not cut rates in May have now risen to 89%. Just like our example in March, the stock market has become very closely linked to the odds the Fed will not cut rates in May. Again, as the probability of no change in rates rise, the stock market interprets this as a sign the economy is strong and corporate earnings will also continue to improve. So where do we stand in terms of the June meeting? At the moment, the odds the Fed will not cut rates in June sit at 29%. So this begs the question, what is needed for the Fed to finally cut rates? Remember our dual mandate. The Fed is watching inflation and jobs. The Fed has been very consistent in stating they want to see the average inflation rate come down to 2%. At the moment, we can see the consumer price index rests at 3.2% and has been stuck in this area for the past 5 months. The Fed is also watching the jobs market. The latest non-farm payroll was reported at 275,000, giving not only the Fed but also the general market a good amount of confidence the economy remains strong. So what does a Fed cut actually look like? What do we need to see? Let's go back to the high rates of '07. Just prior to the Fed's first cut in late '07, the CPI fluctuated right around 2%. And in terms of the jobs market, well, it did not look so good. Remember, our latest jobs update was reported at 275,000. The non-farm payroll in July through September of '07 were reported at a negative 30,000, negative 25,000, and a positive 86,000. Certainly nothing to celebrate at that time. We have another example. Let's consider the rate cuts of 2018. The consumer price index fell to below 2%, remaining in that area for nearly a year, posing no risk of inflation. The jobs market really struggled as well. The non-farm payroll figures just before the eventual Fed cut were reported at 38,000, 204,000, and a meager 90,000. Given the absolute lack of inflation and a deteriorating jobs market, the Fed's decision to cut rates seems appropriate. Again, where are we now? CPI remains well above 2%, and the jobs market is strong, at least according to this barometer. So what's the answer to our question? Will the Fed cut rates in June? The futures not only give us a 29% probability the Fed will not cut rates, but we've seen these probabilities rise in the past. Given the current trend, there's no reason to believe this time will be any different, and we're not alone in thinking this. Recently, Atlanta Fed's President Bostic remarked that we may only see one rate cut this year. In order to see a rate cut, we're going to need at least one of the following to occur. We see the inflation rate return to the 2% area and or the jobs market itself gets in some trouble. And based on our example of 2007 and 18, we have a good idea of what those levels would look like. The Fed has actually been very clear in its intentions and under what conditions they will eventually reduce borrowing costs. Their decision is the result of a careful balancing act between the task of controlling inflation while allowing for a healthy jobs market. And their decision should be deliberated carefully. There's a lot at stake. But the Fed's decision is not a mystery to us. We have history on our side. In the coming days and weeks, we have a number of key economic reports to digest. Based on those readings, the Fed funds futures will adjust and will be armed with the right data to charge forward with confidence.